Tony, let's start there. This is really important. When you see an equity yield that is really, really high, it's not just about whether the stock is underpriced, it's whether the dividend is about to get cut. And for Wells Fargo, it transpires that that is true. I'm just wondering, from your perspective, help guide my audience how you find dependable, safe income in a world of zero rates.
Yeah. Thanks, John. Thanks for having me on. It's a great question. It's an important one for investors because, as you know, we're in a yield-starved environment with the 10-year Treasury at just over 60 basis points. That said, stocks have a yield, the S&P, of just around 2%. And if you go into the value index, the Russell 1000 value index, it's closer to 3%. So there's definitely an opportunity there. But as investors, we need to be on the watch out for dividend cuts. And we've systematically studied this historically. And what you find is the kinds of companies that tend to cut dividends are ones where the business quality is poor, the balance sheets are levered, the payout ratios are high. Often the yields are extremely high. So you want to be careful whenever you see a stock with too high of a yield. And then you also want to look at the earnings stream. How volatile is it? How good are the current trends? And so those are the basic risk factors that we look at.
How much do you have to discriminate within a sector? If you take the financials, for instance, or if you take energy for another instance, if you look at those two sectors right now, within them, you have some big winners and some huge losers. What's the approach there on a sector level, Tony?
Yeah, so the amount of differentiation is greatest in the energy sector. There you see a wide variety of companies in terms of what are their lifting costs? How much does it cost for them to produce an incremental barrel of oil? Also large differences in terms of balance sheets. And we've been stressing this all year, that balance sheets are key because you want to make sure the company you're invested in has the balance sheet liquidity and wherewithal to make it through the other side of the valley. On the financials, I would say that the financials, the banks are more similar on average, and that's because of the sharp degree of regulation they've been put through. So the differences there are fewer. There are some differences in capital ratios, differences in what we call pre-provision earnings. The earnings they get either from net interest income or from capital markets activity, and that's where we've really favored the money center banks because capital markets activity is a strong offset to a world where net interest income is harder to come by.
Tony, from listening to you, though, it just sounds like you think there might be more opportunities in the energy sector where it's more difficult to get your hands around maybe the winners and the losers, and the homework needs to be done there because a lot of people might just look at the energy sector and say, no thanks, not for me, I'm going to avoid the whole thing entirely. Would that be a fair characterization of your approach at the moment?
Well, I think in terms of the overall sector, there's great opportunity in both. These are amongst the most deeply depressed cyclicals, the worst performing sectors of the year. And I think it's really hard to envision a world where we fully recover economically without these sectors doing well. That being said, I do think you're right in terms of stock selection. There's more opportunity as a stock picker to pick between stocks in energy, but I do think there's opportunities broadly in financials. And remember, this distinction between the money centers and the regionals, I think, is an important one for banks generally.